Chapter 5, Business Processing and Record Keeping Rules. 24 questions on the exam come from the information in Chapter 5. New accounts. Required on new account form would be the client's name. Now we have to confirm the client's information, their name, with a photo ID. Probably the most common form of identification we use to do this confirmation is a client's driver's license. We need to collect the client's business as well as their residential address and phone number. We need the date of birth. We need to get the Social Security number if it's an individual or joint account. We need to get the tax ID number if it's some type of corporate or an account for an entity. We need to get information on the client's investment objectives. Are they looking for capital appreciation? Are they looking for income? We need to get information on the place of employment, the name, address, phone number, occupation, a customer or spouse with another firm. So we need to find out if the client or their spouse works with another firm. And we have to do this because of some rules we looked at in a previous chapter relating to Rule 5130, relating to borrowing from or lending to a customer. Now, who has to sign the new account form? Must be signed by the principal only. The customer does not sign the new account form. The registered representative does not sign the new account form. Now, I know what you're saying. You're sitting there going, well, that's just not true. We sign new account forms all the time. Our clients sign new account forms all the time. You got to remember, folks, FINRA rules and regulations are what's being tested here, not what the broker-dealer does, not what PFS Investment does. FINRA says the only signature required on a new account form on the application for an account would be the principal's signature, not the registered rep, not the client. Now, once the account has been established, the information that we've gathered about the client must be verified within 30 days. Now, this information must also be verified and updated every 3 years. You might see on the test every 36 months. Cash account. Now, a cash account is an account whereby the customer cannot borrow money. So if a customer buys $10,000 worth of stock in a cash account, they must deposit $10,000 to pay for the trade in full. No borrowing allowed. Now, there's some accounts that must be opened as cash accounts. Mandatory cash accounts would include retirement accounts, both personal and corporate. So a traditional IRA must be a cash account. A Roth IRA must be a cash account. A pension account must be a cash account. Custodial accounts must be cash accounts. This would include the Uniform Gift to Minors Act, the UGMA account, and the Uniform Transfer to Minors Act, UTMA account. Margin account. In a margin account, borrowing is allowed, which means the customer could buy stock or bonds and borrow money toward that purchase. Now, margin accounts are governed by Reg T, Regulation T. Reg T establishes the margin requirement, the amount of money that a customer must deposit, thereby limiting the amount that the customer can borrow. Now, Reg T, unless you're told otherwise, is 50%. The margin requirement is 50%. So customer buys $10,000 worth of stock on margin, they would be required to deposit $5,000 into the account. They could then borrow the additional $5,000. Now, Reg T is regulated by the Federal Reserve Board. On the exam, you'll probably see this as the FRB. Now, Reg T was created by the Securities and Exchange Act of 1934, but is regulated by the FRB. Margin agreement is required. A customer must sign a margin agreement. Now, they don't have to sign the new account agreement, but they must sign the margin agreement. The margin agreement consists of three parts. There is the loan consent agreement, there is the hypothecation agreement, and there is the loan agreement. The margin account must be approved, that margin agreement must be approved promptly after the first transaction. Now, who would approve this? It would be the principal. Individual and joint accounts. An individual account is an account registered in one person's name, an account registered in one name. Now, an individual account could be marked as transfer on death. On the test, you'll probably see this as TOD. If an individual account is marked TOD, assets in the account will bypass probate. So assets in the account will not be subject to the account owner's will. Assets in the account, however, will be subject to the account owner's estate. So let's say that you have opened up an individual account, marked it as TOD. You've named a beneficiary for the account. Upon your death, the beneficiary will receive the assets in the account. Nobody can fight about that. Nobody can argue about that. Cannot be contested because this is not part of the will. However, the assets in the account that pass to the beneficiary would be included in the value of your estate, the deceased estate. Next, we look at joint accounts. There are two different types of joint accounts. There's the joint tenants with right of survivorship, probably see that as JTWROS, and there's tenants in common, probably see that as TIC. Let's look at the details of the JTWROS account. Equal ownership. Upon death, assets pass to the survivor, and the JTWROS account could be marked as a TOD. I have a JTWROS account with my wife. How much of the account would we own? Equal ownership. Equal ownership. I die. How much would my wife, the survivor, now own the account? All of the account, 100% of the account would be owned by the survivor. Tenants in common. Unequal ownership. Upon death, assets do not pass to the survivor. I have a business partner. My business partner and I have a joint account. It's tenants in common, TIC. I put 30% of the money in the account. My business partner puts 70% of the money in the account. Unequal ownership. I own 30%. Business partner owns 70%. Business partner dies. Do the assets that belong to the business partner, do they come to me? No, they do not pass to me. The assets in the account that belong to me, 30%, stay in the account. The assets that belong to my business partner would pass to the business partner's heirs or business partner's estate. Other accounts. We could open up a partnership account. This is an account for an organization that has been formed as a partnership. Now, if the partnership is going to open up a margin account, we need to get a copy of the partnership agreement to confirm that the margin account is even legal. Some partnership agreements don't allow margin accounts. What else do we need to open this account? We need a partnership resolution. Now, this is for both the margin and a cash account. What is this? This is simply a document telling us who within the partnership has the authority to make investment decisions regarding the account. And again, the partnership agreement is only needed if the account that's being opened is a margin account, if the margin account is being opened or cash account being opened. We also need the partnership resolution. Now, corporate account. Need a copy of the corporate charter of bylaws if the corporation is opening up a margin account. Some corporations don't allow margin accounts. need a corporate resolution if the corporation is opening a margin or if they're opening a cash account. And again, this resolution is going to tell us who within the corporation has the authority to make decisions regarding the account. Fiduciary accounts. Fiduciary accounts would use the prudent investor rule. Now, this rule basically says the only thing that can go into a fiduciary account would be a conservative investment. In fact, some states have a list of securities that would be acceptable for fiduciary accounts. This is known as a state legal list. Now, if we're opening a fiduciary account, we need some type of legal document that has established the organization, that has established the entity, if you will. We would need to get a copy of the trust agreement or get a copy of the document establishing the estate. Now, you notice here that there is no legal document needed to open up a fiduciary account that would be an UGMA or UTMA account. Margin would be allowed if the agreement, the trust agreement, or the legal document establishing the estate allowed for margin trading. Now, with UGMA and UTMA accounts, never could we do a margin trade. Could never be a margin account for an UGMA or UTMA account. Now let's take a look at the UGMA and UTMA account in some detail. Now, the gifts are irrevocable. Money put into the UGMA account or money put into the UTMA account cannot be taken out of the account. Gifts are irrevocable. Now, assets would pass to the minor's estate if the minor were to die. So I set up an UGMA account for my son. I put $100,000 into the account. Could I take that money out of the account? Could I revoke that gift? No, I cannot. What happens if my son dies? Could I revoke the gift? Could I take the money back? No, I could not. Upon the minor's death, assets in the account go to the minor's estate. Now, there is no limit to the gift size. I mentioned a moment ago, I put $100,000 into the custodial account. No problem there, I can do that. But please remember, the Internal Revenue Code, IRC, gift limit applies. The current gift limit under Internal Revenue Code is $14,000 per year for someone who files an individual tax return. So let's say that I am an individual who files an individual tax return. I gave my son a gift of $100,000, put that into one of these custodial accounts. Could I do that? Sure, there's no limit as to the gift size. But the Internal Revenue Code gift limits $14,000. I would have to pay a gift tax on $86,000. Now, the custodian is the donor. If the custodian is also the donor, then they may be reimbursed for expenses associated with fulfilling their fiduciary responsibilities, but they could not charge a custodial fee. They could not charge a fee to manage the account. Now, if the custodian and the donor are different people, then the custodian may charge a management fee for handling the account. Trading authorization. Third-party granted authorization. Someone other than the account owner or owners has been granted trading authorization. There are a couple of different types of trading authorization. These are also known as power of attorney. There's the limited power of attorney. The person who has been given the trading authorization can only trade the account. There's the full power of attorney. Person who's been given the trading authorization can make investment decisions. They have the authority to make trade decisions. They also have the authority to put money into the account and withdraw money from the account. Now, limited power of attorney only allows us to trade, not to deposit or withdraw funds. A durable power of attorney survives mental incompetence of the grantor, the person who issued the trading authority. Now, the power of attorney can be revoked at any time, and in fact is revoked upon the death of either party, the grantor or the grantee, the party who gave the trading authorization or the party who received the trading authorization. Now let's explore this just a little bit. You're a registered representative. You have a client who has traveled out of the country, and you have no way of getting in touch with this client. They left you with no trading authorization. They did not give a third-party authorization to make investment decisions regarding their account. Client's brother calls you up and says, I see that the value of XYZ stock is falling. I need you to sell that stock from my brother's account. Could you accept that trade? No, that would be an unauthorized trade because your client has not left you trading authority. So what would you tell the brother? Sorry, I cannot accept the order from you. When your brother returns or you get in touch with your brother, have him call me. I can only accept instructions regarding trades from the account owner. Now, if the client had given the brother limited power of attorney, you could have accepted the instructions. If they gave them full power of attorney, not only could you have accepted the trading instructions, you could have allowed this brother to deposit and withdraw funds. A wrap account, also known as a wrap fee account. This is where a BD, broker-dealer, acts as an IA, investment advisor. If a broker-dealer offers a wrap account or a wrap fee account, the broker-dealer will charge an account fee based on the value of the assets in the account. So this is an asset-based fee. Now, might the broker-dealer, in addition to the asset-based fee, in addition to the account fee, might the broker-dealer also charge transaction fees? Absolutely, they could. Now, the registered representative who handles this type of account must be registered as an IAR, which is an investment advisor representative. Discretionary accounts. This is where the registered representative has been given limited power of attorney. They can make trading decisions regarding the account. Now, they cannot withdraw money, cannot deposit money, but they can make trading decisions regarding the account. Now, this discretionary authority must be in writing and signed by the customer, and this discretionary authority must be approved by the principal before the account is open. Now, discretionary authority would be required if a registered representative is going to decide action, asset, or amount. Note here that price and time are not discretion. So you're a registered representative. You have a client who has not given you discretionary authority. They call up and they tell you they would like for you to buy 100 shares of a good technology stock. If you entered that order, would that be legal or illegal? That would be an illegal order. The client told you the action, buy, how much, 100 shares, the amount. They let you, the registered rep, decide the asset. You need written discretionary authority from the client approved by the principal before you could enter that order. Now, let's look at a different scenario. You're a registered representative. You have a client. Your client has not granted you discretionary authority. They call you up one day and they tell you to buy 100 shares of XYZ stock, but let you decide the best price or the best time to fill that order. You enter the order. Is that a legal or illegal trade? That's a perfectly legal trade because you're deciding price and time. That's not discretion. The client told you everything that was needed as it relates to discretionary authority. They told you the action, they told you the asset, they told you the amount. If you make any decision about action or asset or amount, you need discretionary authority. What about a deceased customer? How do we handle deceased customer accounts? Well, if it's an individual account and you find out the customer is deceased, you will immediately cancel all open orders. You'll mark the account as deceased, freeze the assets, and then wait for proper court documents and instructions. You'd need to get a copy of the death certificate, affidavit of domicile, inheritance tax waiver, letters of testamentary telling you where these assets are to go. That's for an individual account. What about a joint tenants with right of survivorship, JTWROS? You find out one of the account owners has died. What do? Well, you cannot change the name on the account. You can't take the deceased person's name off of the account until you receive proper documentation, which we saw on the previous slide. But trading continues. The person who survives has the authority to continue trading the account. What if it's a TIC, tenants in common? Name change would pend proper documentation. Could not change the name on the account, could not take the deceased person's name off the account until you receive the proper legal documents, which we saw a few moments ago. This account would indeed be frozen, freeze the assets, no trading allowed. Transactions. Order tickets. When you write an order ticket, certain things must be identified on the order ticket. Time the order was taken must be on the order ticket. The type of transaction. Was this a buy or was this a sale? What's the security? XYZ stock, ABC bonds. Also on the order ticket, we must have the person responsible for the account, the owner. Also on the order ticket, we must have the name of the person who accepted or entered the order. Now, do order tickets have to be approved? Yes. By who? The principal. When? Same day as the trade. But please be careful. The order ticket does not have to be approved by the principal before the order is filled. You write up an order ticket. You take that order ticket to the wire room where the orders would be filled. The wire room at the end of the day takes all the order tickets they received during the day, they put them in a little pile, and they lay them on the principal's desk. The principal then, before they leave for the day, would sign off on all the order tickets. Now, if the principal found an order that they weren't sure about, they weren't happy with, then they would investigate that order further. But order tickets are not approved until the end of the day. Do not have to be approved before the order is filled. Trade date. That's the date that an order is filled. This is the date the customer is economically responsible for the trade. Let's say you put an order in for a customer to buy 100 shares of the XYZ mutual fund. Order's filled. That's the trade date. Client paid $18 a share. The next day, the price of that mutual fund drops to $15 a share. They've lost $3 a share. Customer calls you up and says, I don't want this mutual fund any longer. Too bad, so sad. Once that order is filled, customer is economically responsible. Now, settlement date is the date that the order is completed. This is the date that the customer must pay for the trade if they bought securities, or they would have to deliver securities on that date if they sold securities. Now, there are 3 settlement dates. There's regular way, which is trade date plus 3 business days. Be careful now, weekends are not business days. There is settlement according to cash. There's cash settlement. Here, settlement would be the same as trade date. Dave, why would someone want to settle their trade on the same as trade date? Why would they want to cash trade? Who knows? Who cares? Beyond the scope of what you need to know for the test. And then finally, we have settlement according to Reg T, Regulation T. Now, we saw Reg T earlier as it relates to margin accounts. Reg T does a lot of things beyond margin accounts. One thing Reg T does is it gives the customer 2 additional business days beyond the regular way settlement to pay for the trade. Now, unless you're told otherwise, folks, you always use regular way settlement. Always use regular way settlement. Now, question refers to cash trade. What would settlement date be? Same as trade date. The question refers to settlement according to Reg T. What would you do? You would determine what regular way settlement was and add 2 business days. Trade confirmation. SEC Rule 10B-10. Don't worry about the rule number. Trade confirmation would include details of the trade. Was it a buy? Was it a sell? How many shares? What was the name of the security? Capacity the firm acted in. Capacity of the broker-dealer. Did the broker act as the broker-dealer act as a broker in the trade, which is an agent, or did they act as a dealer in the trade, which is a principal? Also disclosed on the trade confirmation would be the commission if the broker-dealer acted in an agency capacity, if it was an agency transaction. In other words, the broker-dealer acted as a broker. Now, if a broker-dealer fills a customer's order as a broker, they charge a commission. If they fill a customer's order as a dealer, they charge a markup. The commission must be disclosed, not the markup. Commission is disclosed if the broker-dealer acted as a broker, which means they acted as an agent. Also, confirmation must disclose control relationship. Let's say that the broker-dealer is selling a stock of a company that they are the underwriter for. Well, that would have to be disclosed on the confirmation. Now, when does the confirmation have to be provided? Must be provided no later than completion date of the trade, which is settlement date. Account statements. Now, account statements must be provided monthly if there is activity in the account. What if there's no activity in the account? Then the account statement would be provided quarterly. Now, what is account activity? A trade, buy or sell. Customer deposits money. Customer withdraws money. Customer receives a dividend. A simple journal entry by the accounting department. Money going into the account, money coming out of the account. This would be activity. Many years ago, I worked for a broker-dealer. I had a client who wanted a monthly statement, but my client was not an active trader. My client did not have activity in their account monthly. So what we did is we had the accounting department every month journal 1 penny into the account and journal 1 penny out of the account, and that generated a monthly statement. That was activity. Good delivery of certificates. A customer has sold either stocks or bonds, and now they must deliver certificates. So the customer actually has possession of the stock or bond certificate. Customer must sign the certificate. Now, the signature must be the same as the name printed on the certificate. Invalid signatures would include minors, deceased persons, persons who have been declared mentally incompetent by a court of law. Now, many times customers don't want to sign a certificate. They don't want to do that. What could the customer do instead? They could sign a power of substitution, which is a stock or bond power. Let's say that I am a customer and I bought some stock several years ago. I had a certificate registered in my name and delivered to me. I keep that certificate in a safety deposit box. I sell the stock. I've got to deliver the certificate to the broker-dealer no later than settlement date. And I must sign the back of that certificate, and my signature would have to be the same as the name printed on the front of the certificate. I do that. I sign the back of the certificate, I put it in an envelope, and I mail it to the broker-dealer. The certificate gets lost. Is that a problem? Yeah, that's a negotiable document. Yeah, that's a problem. I don't want to do that. I don't want to do that. I don't want to run that risk. So what do? I get a power of substitution. I'll get a stock power from my broker-dealer, printed off the website. I sign the stock power. I do not sign the stock certificate. I mail the stock certificate unsigned to the broker-dealer. I mail the signed stock power in a separate envelope to the broker-dealer. If either of those gets lost in the mail, no harm, no foul. Broker-dealer receives the stock certificate unsigned. They receive the stock power signed. They put those two together. They've got a stock certificate that has properly been endorsed. Now, the bond power works with a bond certificate. Now, at times, and this is most of the time, a transfer agent will require the signature to be guaranteed. What if I bought stock several years ago, had a certificate registered in my name and mailed to me, and my dog got a hold of the certificate and mutilated it? Or maybe I spilled some type of ink on the certificate. It's mutilated in some way, shape, or form. Could I deliver this mutilated certificate to my broker-dealer and that be good delivery? No, I could not. Now, could go to the transfer agent and they ask the transfer agent to attest to the fact that this certificate was issued to me, is still outstanding, therefore the transfer agent has attested to the to the certificate. I would then be able to endorse, deliver, and that would be good delivery. Record keeping and retention rules, 7A-3 and 7A-4. Again, don't worry about the rule number. Some records have to be kept for 3 years, some records for 6 years, some records for a lifetime, and then we have other times that records have to be kept. So, what records have to be kept for 3 years? Communications, things that we communicate with the customer, retail communications, correspondence. Focus reports, those financial reports that we file with FINRA, trial balances, Form U4 and U5, trade confirmation, and order tickets. Those are 3-year records. 6-year records would be blotters, general ledger, stock ledger, customer ledger, which is the account statement, okay, customer account records, and the designated principal. Who is the principal in the office? Who's the principal who is managing the account? Lifetime records, stock certificate book. So if the broker-dealer has issued stock, there would be a certificate book kept for lifetime. Partnership agreement or articles of incorporation. Board or partnership minutes. Others, customer complaints are kept for 4 years. FinCEN records, this has to do with the currency transaction and SARS reports, are 5-year records. Please commit these to memory. I do expect you to see questions on the exam about how long certain records have to be kept. So please learn this information here. Really important. Now let's look at the Securities Information Center. Now on the test, you'll probably see that abbreviated with SIC. Now we're going to be dealing with lost, counterfeit, or stolen certificates, Rule 17F-1. Again, don't worry about memorizing the rule number. Now, you'll see the rule number in the question, but then the question will talk about lost, counterfeit, or stolen certificates. So you'll know exactly what the question is asking you. They're not going to expect you to know what 17F-1 is. So, a broker-dealer has lost securities that a customer has deposited with a broker-dealer. So customer has stocks or bond certificates on deposit with a broker-dealer. Broker-dealer's providing a place of safekeeping. Broker-dealer cannot find these certificates. What's the broker-dealer going to do? Well, they have 2 business days to locate these certificates. So they'll go rummaging through their files to see if they can find the certificate that has that's been lost. Now, if they cannot find the certificate, on the 3rd business day, they will report to SIC and the transfer agent that the certificate has been lost. Now, if the certificate is later located, then they would notify these same parties that the certificate has been found, and they would do this notification within 1 business day of finding the certificate. What about stolen or counterfeit certificates? A broker-dealer comes to work one day, principal comes into the office one day, and they unlock the front door, and they discover that there's been a burglary overnight. Somebody broke in the back door of the office. The place is in shambles. Certificates are missing. Stolen. What happens? Report the fact that these certificates have been stolen to SIC, FBI, and transfer agent within 1 business day of discovery. Now, if these are later located, we would notify those same parties within 1 business day that certificates have been located. When would a broker-dealer have to inquire with SIC to find out if these certificates are legitimate, maybe they're counterfeit? When would the broker-dealer have to inquire? If a new customer is depositing securities, depositing certificates, they have to inquire. Customer opens up an account. This is a new customer, never done business with these people before. They deposit certificates into their account, got to go to SIC and do an inquiry. Or if certificates are received by a customer in street name, that means the certificates are registered in the name of a broker-dealer. A customer should never have certificates registered in the name of a broker-dealer unless those certificates were stolen. Bearer bonds. Customer deposits a bearer bond into their account. Must inquire with SIC unless the firm sold the bonds to the customer. Now, what's a bearer bond? Don't see bearer bonds very much anymore. Bonds are no longer issued in bearer form. There's still some out there in the marketplace, but they're no longer issued in bearer form. All bonds nowadays would be issued in registered form. But a bearer bond is a bond whereby the person who bears the bond certificate owns the bond. So if a broker-dealer receives bearer bonds that they did not sell the customer, must inquire with SIC. If anyone remembers the original Die Hard movie, when the bad guys broke into Nakajima Tower, what were they after? Bearer bonds. Because whoever bears the bond, whoever holds the bond certificate, owns the bond. So the SIC inquiry would have to be launched in this case. Now, when would a broker-dealer not have to inquire with SIC? Would not have to see if the certificate is stolen or counterfeit, right? If the certificate is received from the issuer, or if certificates are received from another broker-dealer, or if certificates are received registered in the name of the customer, unless it's a new customer, or if the bearer bonds are deposited by the customer and the firm sold those bonds to the customer. Have a customer who bought some bonds. We had bond certificates issued to the customer. These bonds were issued in bearer form. We know this customer received those bonds. They later delivered them back into the account. We do not have to inquire. Types of broker-dealers. The first broker-dealer we're going to look at is a clearing firm, also known as a carrying firm. Minimum net capital on the test NC for a clearing firm is $250,000. Now, this firm clears their own trades and those of introducing firms. They carry customer accounts, they accept customer funds and securities, certificates, and they can participate in a firm commitment underwriting in any capacity. This would be a very large broker-dealer. They execute trades for their customers. They also execute trades for other smaller broker-dealers. They carry customer accounts, which means customers have their assets on deposit with the broker-dealer. They carry the customer's account. They carry the customer's account. Some small firms, in fact, most small firms, don't carry a customer's account. The customer, their account would be carried by the carrying firm or the clearing firm. So we'll look at an introducing firm here in just a moment. The introducing firm introduces the customer to the clearing firm, and the clearing firm actually carries the customer's account. Now again, a clearing firm, a carrying firm, could participate in a firm commitment underwriting in any capacity. They could act as a manager of the underwriting group, known as a syndicate. They could act as an underwriter. They could act as a selling group member. So they could fill any type of function within a firm commitment underwriting that would be involving a syndicate. Introducing fully disclosed firms. These are those smaller firms that I mentioned earlier. An introducing firm is a firm that would not carry a customer's account. They would not clear their own trades. They would not execute trades for their customers' accounts. Their customers' accounts would be at the large firm, the carrying firm. Their trades would be cleared, would be executed by the carrying firm. Now, there are two types of introducing or fully disclosed firms. By the way, the reason these are known as fully disclosed is because the client information is fully disclosed to the carrying firm. And it's disclosed by who? The introducing firm. Now, there are two types of introducing firms, and each of these has different minimum net capital. We have one introducing firm that could accept securities from their customers. There, the net capital, minimum net capital is $50,000. Now, they may not accept, the introducing firm may not accept money from the customer. They could accept securities, but no money. Money would have to be deposited with who? The carrying firm. The carrying firm. Now, we also have an introducing firm that would not be allowed to accept securities from a customer. There, the minimum net capital is $5,000. Minimum net capital is $5,000. Customer would deposit their securities and cash with who? The clearing firm. The clearing firm. Now, folks, you do not need to worry about how net capital is calculated. You need to know what net capital is. Now we have a group of broker-dealers that would offer mutual funds only, mutual fund firms. We have two types of mutual fund firms. There's the wire order firm, and there's the firm that accepts applications, accepts paper applications known as subscriptions. The wire order firm has a minimum net capital of $25,000. The broker-dealer, the mutual fund broker-dealer that accepts paper applications only, would have a minimum net capital of $5,000. Now, the mutual fund broker-dealer holds no customer securities, no assets, no money. They agree to promptly transmit funds to the distributor or the sponsor. Now, the distributor or sponsor is the underwriter. So let's say that you work for a broker-dealer that is a mutual fund firm. In fact, you do. Okay? You sell a mutual fund to a client. The client would send their check to the broker-dealer, to the mutual fund company, to the mutual fund firm to the mutual fund broker-dealer, the broker-dealer would take the customer's check and they would forward it timely, that would be within 24 hours, to the distributor, also known as the sponsor, who is the underwriter. Now, those checks would have to be made payable to the mutual fund company, not to the mutual fund broker-dealer. Folks, please remember these minimum net capital requirements. I do expect you to see this on the test. For a carrying firm, that's that large firm, $250,000 is the minimum net capital. For an introducing firm that accepts securities, $50,000. For an introducing firm that does not accept securities, $5,000. For a mutual fund wirehouse that accepts wire orders, which are electronic orders, not paper orders, $25,000. For a mutual fund that accepts subscription, which are paper applications, paper orders, that would be $5,000 would be the minimum net capital. Again, never going to ask you to calculate minimum net capital. They will expect you to know what the minimums are. Customer Protection Rule, Rule 15C3-3. Now, this rule is designed to protect customers' net credits. So, some customers owe broker-dealer money. Some customers are owed money by the broker-dealer. So we take the money that a broker-dealer owes a customer, and we take the money owed by a customer to a broker-dealer. We net those together. If we have more money that the broker-dealer owes to a customer than the customer owes to a broker-dealer, that's a net credit. Now, under the Customer Protection Rule, broker-dealer must do a reserve calculation on Friday of each week. They must then deposit the amount of the net credits into a special account at a bank no later than 1 hour after the bank opens, 2 business days after the calculation. Whew. So that would be no later than 1 hour after the bank opens on Tuesday. Calculation done on Friday. 2 business days after the calculation would be the following Tuesday, assuming Monday's not a holiday. No later than 1 hour after the bank opens on Tuesday, broker-dealer must deposit an amount of net credits into a special account. Now, reserve calculation completed on the last business day of the month, not weekly, but on the last business day of the month, if the net credits would be less than $1 million. So we would offset the money that we owe to our customers versus the money that is owed to us by our customers. We'd offset those two numbers. If we end up with net credits less than $1 million, then we could do this reserve calculation not weekly but monthly, and it will be on the last business day of the month. If we do this monthly calculation, we have to deposit 105% of net credits into a special account no later than 1 hour after the bank opens, 2 business days after the calculation. So let's say the calculation is done last business day of the month is Tuesday. We would have to deposit 105% of the net credits no later than 1 hour after the bank opens on Thursday. Now, this deposit into the special account would have to be either in the form of cash or U.S. government securities. The T-bills, the T-notes, U.S. government securities. Okay? Now, if it is a weekly calculation, how much has to be deposited? 100% of the net credits. If it's a monthly calculation, how much must be deposited? 105% of the net credits. Securities Investor Protection Act of 1970. This protects customers in the event of a broker-dealer bankruptcy, broker-dealer failure. The Act of 1970 created the Securities Investor Protection Corporation. You'll see that as SIPC. Now, SIPC coverage is per separate customer, not account. SIPC coverage is $500,000, including securities and cash. Of that $500,000, no more than $250,000 is in cash. What if there are assets in the account beyond SIPC limits? What would the customer do? They would go to the bankruptcy court and file as a general creditor. Now let's explore this just a little bit. SIPC coverage is per separate customer, not account. How does that work? Let's say that I have an account registered in my name only at a broker-dealer. With that same broker-dealer, I have an account registered in my name and my wife's name. So two different accounts, each titled differently. I'm seen as a separate customer on each of those accounts. So I have two sets of coverage. Accounts titled differently, I'm seen as a separate customer. In both cases, I have two sets of coverage. What about this? I have a cash account in my name only with a broker-dealer. Also have an IRA account with that same broker-dealer in my name only. Two different accounts, both titled the same. I'm seen as one customer. I have one set of coverage. One customer, one set of coverage. Okay? Now let's talk about that $500,000 coverage, securities and cash, no more than $250,000 in cash. I have $200,000 in securities in an account. Also have $300,000 cash in the account. Now, cash is a free credit balance, not a money market mutual fund, but a free credit balance. So $200,000 in securities, $300,000 in cash. My account is valued at $500,000. Do I have $500,000 worth of SIPC coverage? No, I don't. No, I don't. Because of that $300,000 in cash, only $250,000 is covered by SIPC. So $200,000 of the securities would be covered. $250,000 of the cash would be covered. I have $450,000 worth of coverage under SIPC. Now, that's $50,000 worth of cash that is not covered by SIPC. Where would I go to try and recover that money? Bankruptcy court. File as a general creditor. File as a general creditor. Now be careful, folks. SIPC is designed to provide protection if a broker-dealer fails, not money that we lose because of trading. Only if the broker-dealer goes out of business, goes bankrupt. I buy $20,000 worth of a mutual fund, the value drops to $15,000. How much coverage do I have under SIPC? Zero. That's a trading loss. That's not covered by SIPC. That brings us to the end of Chapter 5. 24 questions on the test. Test tips. Read the full question, RTFQ. Folks, it's really important. You got to read these questions very, very carefully. Questions are worded in such a way as to try and confuse you, and you really need to be careful. And the way that you can overcome the questions being worded to confuse you is to read the full question. Don't scan it, read every word. Read every word. You've been working on practice questions. You've discovered this. You read a question, you don't read it carefully, you get the answer wrong. You really go back and read that question carefully. Of course you know what the answer was if you'd bothered to read the question. Another reason you want to read the full question, answer what you've been asked. Answer what you've been asked. Don't add to the question. Don't take away from the question. Read the full question and answer the question you've been asked. Read all possible answers. Look at answer A, B, C, and D. Don't pick the first answer that you come to that you think is right. You look at the answer A. That's right, you pick it. You don't bother to look at B, C, and D. Well, A was right, but if you'd bothered to look, D was more right. Don't change answers. Statistically, 75% of the time, when we change an answer, we change from a correct answer to an incorrect answer. I've been teaching securities material for many years. I've talked to a lot of people who've taken these exams and passed, a lot who've taken the exams and failed. I can tell you that many times people fail scoring between 65 and 69, and many times people change 3 and 4 and 5 answers and score a 68. Statistically, I know they have changed their grade from a passing grade to a failing grade. Don't change an answer unless you are absolutely sure the answer you have marked is incorrect. Use a calculator to work on any math questions. Don't try and do the math questions in your mind. Don't do them in your mind. Get a calculator. You cannot take a calculator to the testing center, but the testing center will provide you with a calculator. Use it. Watch your time. Manage your time. Don't run out of time and have 10 or 15 questions left. Those questions that you don't answer will be marked incorrectly. Folks, I would never spend more than maybe 2 or 3 minutes on a question. I wouldn't. I would not spend 10 minutes on a question, run out of time, leave 10 questions unanswered. If I happen to get that one question that I spend 10 minutes on right, that's 1 right for 10 wrong. It's not worth the trade. Be rested before you go take the exam. Don't go in there after having crammed all night for the test. Our brains don't function well if we're not rested. Calm your nerves. I know you're going to go into the testing center and you're going to be nervous and you're going to be anxious, but I want you to calm down. Take a few deep breaths after the test has begun. Think about something that is calming to you, maybe the beach or a high mountain meadow, but calm yourself down. We don't function well when we're nervous. And finally, arrive early. Plan on arriving at least 30 minutes early. Now, you want to do this so that if you get caught in an unexpected delay, you're not going to start freaking out. You're not going to get nervous. Oh, man, I'm going to miss this test. I can't believe it. They're going to cancel. I got to open a new window. I got to pay another fee. It's crazy. Arrive early and take all that stress off of yourself. We hope the information we've shared with you over the past 5 chapters of The Edge will help you be successful as you study for and take your exam.